Greetings. In this video, we're going to be taking a look at the Great Recession, which was a period of time in our history, U.S. history, where we suffered a rather major downturn due to a financial housing crisis. In the last video, we looked at the pre-2007 period and saw that the Fed was operating in what we call a limited reserves system. And what I'm going to show you in this video is that continued into 2008, but by 2009, the environment had changed and we had moved into what we call an ample reserves environment. And this was all based on the Fed's actions in response to the Great Recession, which is what that period was called. It's also called the financial housing crisis of 2007 to 2009. If we look at 2008, we see that the supply curve for reserves has moved dramatically to the right, okay? And I'm just going to change my color here. Let me get to red, and you'll be able to see this better. So by 2008, the Fed has moved the supply curve for reserves dramatically to the right. If you recall, back in 2007, back in 2007, the discount rate was way up here at 6.5%, and the federal funds rate was way up here at about 5%. Okay, so what the Fed did between 2007 and 2008 was dramatically increase the level of reserves, and it was over a $1 trillion increase in bond purchases, government bond purchases, and the purchase of what we call mortgage-backed securities. And we'll be talking more about mortgage-backed securities a little bit later in this video, and I strongly encourage you to take a look at the e-workbook where I explain that more fully. But what's going on between 2007 and 2008 in the United States is we're entering into a financial crisis. And banks have made some really silly loans between the year 2000, 2001, and 2007. Credit conditions in the mortgage market were very, very loose. Loans were being made, housing loans, mortgages were being made to people who really couldn't afford homes. It was an attempt to make housing more available for the poor, which is a great idea, but there were people buying homes that couldn't afford them. They didn't have the income to actually make the payments. Loans were still being made to those people. And what happened by 2007, 2008 is many of these loans were not being repaid, and banks were really starting to suffer. Loans were not performing, and word was starting to get out that banks were struggling. And of course, when depositors hear that banks are starting to have problems, they're getting edgy and they're starting to look at ways to maybe pull deposits out of the banking system. And this begins to lead to a financial crisis in the banking system. So the Fed was already anticipating this, began to see this occurring, and the Fed began to move aggressively to push more reserves into the banking system through open market operations, that is, buying government securities and these mortgage-backed securities. By doing that, you push the price of those assets up and you push the yield on those assets down, and you also push a lot of reserves into the banking system, which tends to take the pressure off banks. If they have more reserves, they've got more of a cushion to absorb loan losses or to see deposits pulled out. Okay, so the Fed was pumping reserves into the banking system to try to shore up a weakening banking system. And notice that by 2008, the discount rate has dropped to 3.5%. The Fed lowered it from 6.5% to 3.5%. That's a historic drop. I mean, that's an amazing drop in 1 year. That's how spooked the Fed was about this. The Fed was really concerned that we were heading not into just a Great Recession, but to possibly into a Great Depression. So the Fed moved very aggressively between 2007 and 2008, lowered the discount rate. Just a reminder, the discount rate is the interest rate that banks have to pay if they borrow from the Fed. And in fact, what the Fed was communicating was, hey, if you're having trouble, come borrow from us. We'll help you out and help you move through this crisis. And because the Fed lowered the discount rate, it flattened. If you can see this right here, the Fed flattened the demand curve for these reserves in the federal funds market. So the demand curve, if you recall in the 2007 picture, it was much steeper. Had a much steeper slope on it, but by lowering the discount rate to 3.5%, you actually flatten that demand curve out. And then notice that the Fed is still, even though it's increased reserves a lot, it's still operating on a downward sloping portion of that demand curve. So this still means we're still in a limited reserves. Sorry about that. I can do better than that. Reserves, not much better. And what we see is the Fed is still able, through open market operations, to push the federal funds rate down. And look at this, dropped all the way from 5% all the way down to 2% in a year. That is a dramatic drop in interest rates. So if you actually look at the data between 2007 and 2009, if you look at the data in 2007, the Fed has 0.873 trillion, so less than a trillion, in assets. So the Fed's assets, let me write this out for you. By the way, I hope you're taking some notes, because you need to get this off the paper, off the screen, into your head. So the Fed's assets in 2007, again, this is the left side of the Fed's balance sheet. This is going to represent the assets it's purchased in the open market or through purchasing these mortgage-backed securities. By 2009, the number is 2.084 trillion. So in less than 2 years, look at this. In less than 2 years, the Fed has basically doubled its assets, which means in all of the time period up to 2007, it had accumulated less than $1 trillion in assets. In 2 years, it doubles that. That's a dramatic, historic increase in the Fed's assets. The Fed is serious about shoring up the banking system because it's fearful that the banking system is about to collapse in a major way. And we're talking again about not a Great Recession, but a Great Depression. And this, of course, happened during the Great Depression in the early 30s. And the Fed was bound and determined to not let it happen again. So the Fed acted very, very aggressively in 2008. But I'm going to scroll down here. By 2009, look at this. Look at this. The Fed has pushed reserves, so many reserves, into the banking system by 2009, as we just said, that the Fed's supply curve is no longer intersecting the demand curve at a positive rate. So in other words, the federal fund rate has been pushed all the way down to zero. Zero. And this has actually got a name. I'll just back then it was coined and is still coined zero interest rate policy. Now this doesn't mean all interest rates are zero. You'll hear this term used even today. It doesn't mean that all interest rates are zero. It means that the federal funds rate was pushed down to zero. And then of course other interest rates are built off of that. Notice also that the discount rate was lowered down to 0.5%. So in other words, and we know that this sets a ceiling on where the federal funds rate could go. So not only did the Fed push the federal funds rate down to zero, but then it lowered the discount rate, signaling that it didn't want the federal funds rate to go back over 0.5%. In other words, it not only lowered it to 0%, it's basically stating to the world it intends to keep it at 0% for a while. That's interesting. Notice how flat this demand curve gets. It's a very gentle slope now because the federal funds rate is so low there's not much room for it to dip. This is called ample reserves. So what the Fed did in a matter of 2 years was move from a very limited reserves system to a very, what it now calls, ample reserves system. And you're going to learn that between 2009 and 2023, this supply curve has been moved even further to the right. It's incredible. You'll be shocked to see the numbers later on. And so where are we now operating? We are now operating out here in the realm where the supply curve hits the demand curve at 0%. Okay, that's where we are at 2009. And actually this carries all the way to 2015. But I'll be talking about that more in the next video. So what we've done, and this is what the purpose of this video is to show the transition from a limited reserves environment to an ample reserves environment. And this was done through dramatic historic levels of open market operations and what is also called quantitative easing. Okay, now again, I just want to reiterate that zero interest rate policy doesn't mean all interest rates are at zero. It means the federal funds rate, which is within the Fed's control, is at zero. And then the banking system, if you add the 3% on, you get the prime rate. So interest rates for businesses, the best business customers, was very low at this time. In other words, businesses that needed help, the Fed was sending the signal as we want to keep interest rates low so you can continue to invest and do what you're doing. And then, of course, the nice thing for consumers was this pulled down the credit card rates. So the best best credit card rates dropped down to in the neighborhood of 7%. Sometimes they're even lower than this. Now, all of that, let's get back to the major macroeconomic effects here. I just drew a model you should be familiar with here. This is out of Unit 2, Topic 2, and this is basically showing a business fluctuation. So we have A, which is the peak, B is the trough, and let's say that at this point here, right here where this X is, there's recognition. Let's say we're recognition that policymakers are recognizing we're heading into a recession. There's a meltdown going on in the banking system. There's a crisis in the banking system, and if we don't do something, this is going to be a major recession or perhaps a depression. I mean, that's what the talk was. If you were cognizant of economic things in 2007, 2008, that was the talk. The talk was we're heading into a major financial crisis. And of course, the media, gets all zipped up about this stuff, and we're talking about the Great Depression. We're talking about going back to the early 30s. So the whole purpose of this, and you have learned this in Unit 2, this is a continuation of Unit 2 thinking, is that if you can lower these interest rates, then you can boost interest rate sensitive spending. So you can boost consumption, so it'll be easier for households to buy durable goods. It'll be easier for them to buy cars. It'll be easier for them to put things on credit, buy things on credit. And by lowering interest rates, you raise investment rates, because a lot of investment is financed by borrowed money. Okay? And strong consumption and strong investment leads to what? Stronger GDP and lower unemployment. Okay? So the whole purpose of the Fed boosting the amount of reserves in the banking system was to push interest rates really, really low as they could go through open market operations, and that would be zero, and to push up interest rate spending and hopefully boost GDP and help avoid what appeared to be a very severe coming recession, if not a depression. Now, what we're going to learn moving forward is we are still in this ample reserves system. So open market operations were so successful in pushing interest rates down that they're effectively no longer effective. You go, what? What are you saying? That open market operations have so dramatically pushed the supply curve to the right that it no longer intersects the demand curve at a positive interest rate. So effectively, you're going to see that this supply curve is way out here now on this flat portion, and movements in this supply curve now have no effect on the federal funds rate. So effectively, we've put so many reserves. I say the Fed has put so much reserves into the banking system that movements in reserves in that supply curve no longer affects the federal funds rate. So we're no longer in a limited reserves system where open market operations can affect that rate. So we're going to learn in the next video that the Fed has had to come up with another tool to move the federal funds rate, either up or down. And that's going to be the story in the next video. So I hope this has been helpful. It's been a history lesson, yes, but a lot of macroeconomics was birthed out of the Great Depression in the early 30s as a science. The economists got interested in studying these macro phenomenon after the Great Depression. And so history and what's actually happened empirically is what has helped lead to the formation of theory to explain it. So real life events inform our economic theory. In other words, our theory needs to explain what's happening in the real world. And that's the reason we study macroeconomics. I hope you've enjoyed this video. At least I hope it's been helpful to you. We'll see you next time. Take care.